Hey everyone, welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm going to be talking about how to adjust BPO values as part of your due diligence process. Before I get into that, just give you a few updates on some things that I've been up to. Been bidding on a few notes here and there, haven't been super aggressive in that the last couple of weeks just because so busy with other things in life. However, continuing to see the supply of notes titch up. So I'd say market conditions have been gradually improving over the last several months, which is a good thing. And I would expect that trend to continue over the course of the year. I don't think we're necessarily going to see, an epically massive influx of notes or some kind of gigantic economic event. I think I'm probably still more bullish than most overall at the state of the economy, but I think we'll continue to see opportunities and notes as we progress through 2023. A couple weeks ago, did a webinar for Real Estate IQ. That was pretty good. I did that on how to get started in notes. And so if you go to Real Estate IQ, you should be able to get a replay of that. I've also got one. You can always drop me an email if you'd like, and I can send you the link to that replay. And I'm going to be doing another webinar for Real Estate IQ at some point here coming up in May. So if you've got any topics for that, please let me know. If there's anything in particular that you'd like to learn more about. Also recorded a podcast in the past week with the Paper Stack folks with Brett Berkey and them. And that one was on my first note deal. So once they publish that, it becomes available. I'll send out a link to you guys. I may also see if they can give me permission, maybe I can repost it on the Note Investor podcast feed and on my channel. But there are a lot of interesting learnings there too. That was a story of my first note that I've never actually really talked about before. I'm not sure exactly why. So I'll see if I can get that copy from them. But anyways, getting into the topic for today, which is adjusting values on your BPOs. So if you're not familiar with these, a BPO is called a broker price opinion. It's basically an estimate of the value of a property. So you'll order one of these. You can order these from a number of national companies. I use Baldwin Advisory Group pretty commonly. There's companies like Sandcastle that will do them and a lot of others. Occasionally, I'll just contact realtors directly and ask for them. Sometimes, if I'm contacting the realtor directly, I generally offer to pay them, although I've had realtors do it for free as well. These things typically cost about $100, give or take, depending on where you go. But when you order this broker price opinion, what they're going to do is the realtor is going to go by. They're going to take photos of the property. They're going to pull a lot of data on the property itself. They're going to pull comp data, and they're going to put all that together into an analysis of the value. And they'll give you a couple values on there. Like they'll give you a suggest or um, expected sale price, and then they'll typically also have a quick sale price, which is a little bit lower. So the sale price being if you do a standard like 60 to 90 day listing, or the 30-day quick sale if you just want to sell it off fast. So that's might have lost my sound. I think I'm still there. Sorry about that. So that's in a nutshell kind of what a BPO is overall, but you have to understand that there are some key limitations with these. One of them is that when the realtor goes through and they take their photos, right? What you'll notice on the BPO is they're going to make a bunch of annotations and deductions for anything that they see wrong on the outside of the property. So, for example, they might see damage to the roof, damage to a porch. There might be general poor condition, junk in the yard, things like that. So what they'll do is they'll come up with like the value based on comps, and then they might make deductions for different amounts of damage that they see. Um, but you won't see anything for damage on the inside. Why? Because with exterior BPO, your realtor can't get inside, right? So if we're looking at buying a loan, you don't have any rights to go inside the property, unlike a more traditional real estate transaction. So, not being able to see the inside of the property is one thing that kind of weirds out new note investors sometimes. They're like, hey, I'm spending all this money on this deal. I want to see the inside. Why can't I do that? Well, when the loan's trading hands, you can't, right? So if you've ever had the mortgage on your primary residence change hands, like I have a handful of times, you'll notice no one ever comes in and looks, right? So when I bought my house a year and a half ago, 2 years ago, and then the loan was sold to Chase, Chase might have sent somebody to drive by and look at it. I wouldn't know, but they certainly didn't have anyone come and look at the inside. So not being able to see the inside of the property is one of the key risks associated with note investing. Um, and I'm here to tell you that the condition of the inside of the property can sometimes vary dramatically compared to the condition of the outside of the property. I have a number of cases where this has happened, where the outside actually looked pretty good, and then got the property back through foreclosure, cash for keys, and then you look on the inside and it's just an absolute wreck and a horror show. I had one in Muncie, Indiana one time. I actually visited the property myself, nice neighborhood, yard was in pretty good condition. Um, and then after taking it through the foreclosure process, found out that the whole place was wrecked. The furnace didn't work. They had these dogs that had pooped everywhere. The place like reeked of dog poo and ended up having to have the vents completely cleaned out, had to have the home repainted with this special paint that destroys smells. And you would not have known that from looking at the outside. Now that's kind of rare that, to have that extreme of an example. But another thing I've observed is that if you do see defects on the outside of the house, or say like any trash or anything, you can bet your life that inside the house is going to be much worse, right? So if someone's not taking care of the outside, they're sure as not heck not taking care of the inside where they live. And there's a lot of reasons for that. I mean, if you look at the kind of borrower who just rides the ship down in a foreclosure, especially my borrowers where they have a lender like me who is going out of their way to try to reach some kind of agreement and keep them in the house, they live a pretty laissez-faire lifestyle and they neglect their finances, obviously, but they tend to neglect all kinds of other things as well. So they are sure as heck not doing a lot of maintenance on the inside of the house. Now, back to the BPO, right? So when you see the BPO, they make deductions for the defects on the outside of the house. You won't see any deductions for defects on the inside. Why is that? Well, it's because they can't see the inside. So what the realtor is essentially doing when they don't deduct anything for the inside is they're assuming that the inside is pristine. But we know darn well that the inside is never going to be pristine. So there are other deductions that should be on there that are not. And what that means is your BPO value is going to be inflated to some degree or another. So what do we do about that? Like, how inflated is it going to be? Well, that's where mileage varies, right? And I'll get into that in a sec, but just one other point about why BPO values can be off or be inflated sometimes. In a handful of cases, I pulled two different BPOs on the same property. I don't generally do that, but sometimes if the structure of the deal is particularly sensitive to the value of the property, I might pull two just to get a second set of eyes. And I've had a couple cases where I've ordered two BPOs from different agents, and they've come back with very different estimates of the value, right? So if I had pulled one and I got the high one, I would have a radically different sense of the value than I did from the low one. And when this happens, I always go back and talk to both of the agents and ask them about it. And in one case in particular, there were a lot of aspects of the neighborhood that one of the agents didn't understand. And when I talked to the agent with the lower value, she explained about this shuttered factory down the street, and how down the street there were these houses that were boarded up and there was this problem and that problem and the neighborhood. So in that case, I believed the lower value. So you can never take BPO values at face value. Now, does that mean they're not worth getting? No, you absolutely still want to get them for a couple of reasons. One, you want to make sure you get eyes on the property. I mean, one of the most important things you're getting from those are photos, right? And then you're getting a starting point for the value. So now that we've established kind of what a BPO is and that we can't just assume the value we get is holy gospel, we need to what I call knocking it down or adjusting the value, right? Some amount. So how far do we go? Well, in adjusting your BPO values, mileage varies. So one indicator is the overall value of the property, right? So a higher value property, the BPO is going to tend to be closer to the real value than not. So if you're talking about say a $400,000 property, that BPO value is going to tend to be more accurate. There's generally less variation in sale prices among those kind of properties. And even if the borrowers, loses one of those in foreclosure, they tend to do more maintenance than borrowers in lower value properties. So if we're talking value properties where the values are say under 80,000, especially when you go down to that 50, 60,000 range, then I'm going to knock them down even more because there's a lot more variability in those low value properties. So to try to come up with some estimates of how to adjust these, I went and looked at some of my actual data from about 8 or 10 properties that I ended up with the asset, either um, doing a forfeiture on a contract for deed and then selling the REO myself. Some of these went through sheriff's auctions. Um, but what I did was I looked at those 8 or 10 deals and I compared them to the original BPO values I pulled to see what the difference was. Now there was a lot of variation in the data. One of them, there was another one I had that was a pretty extreme example where the inside was just really in terrible shape. But overall, the property sold for about 60 to 70% of what my original BPO value was. And some people might be surprised to hear that, but really for the reasons I already gave, it's not that far off. So, as a general rule of thumb, again, mileage varies depending on whether you're talking about a higher value property or lower value property. I usually use something in the order of about 70% of the BPO value when I'm doing my pricing, right? So if I'm doing my pricing and I'm looking through this scenario where I end up with the property either through foreclosure, cash for keys, and I'm selling it myself, usually I'm selling these just to like a local fix and flipper, something like that, local investor. I use about 75% of my BPO value. So if I pull a BPO value and it's $100,000, well, then I'm going to assume that if I get the property back and sell it, I'm going to be selling it for about 70, right? So that would be sale price of 70, but then I would also have to factor in selling costs. And then, of course, I would have all my other expenses associated with the deal, such as legal fees and servicing fees and delinquent taxes and all of that other fun stuff. So, keep that in mind when you're bidding on assets and you're looking at those foreclosure scenarios. Um, People often make the mistake of being too aggressive with the value, but you got to remember if you have to take it through foreclosure, it's telling you a lot of things. One, this borrower is willing to ride the ship down. And if the borrower is willing to do that, they might live a rough lifestyle. The other factor is if the borrower is willing to let it go, it could be because there's something wrong with the house. Like if everything is pristine and they have all this equity, it's less likely they're going to do that. So when you're plotting out that scenario of foreclosure, you got to think about all the things that go with it. Um, and then always get your own BPOs. Sellers will sometimes provide them, which is terrific, but you always want recent pictures and it always pays to get your own. But I've seen this before where sellers offer a BPO and say, hey, here's the BPO, and they want you to treat that value as holy gospel, and it just never is. So get your own estimate, make your own adjustments, and hopefully that helps you out in your due diligence processes. So That's it for today. Thanks for listening, and I will see you guys next time. Bye.